Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 1st, 2024. We're kicking off the first trading day of the second quarter of the year. Hope everybody had a good, nice long 3-day weekend. Enjoyed your Easter weekend if that's your thing. Of course, if you're here in the States, you had a 3-day weekend. Remember, markets were closed Friday, so we're picking back up and where we left off on Thursday. Here's what I'm going to do in this video. I'm going to first just, as I like to do, go through questions. There are a couple comments, mostly just capitulation type stuff on, what was that, the first post on Thursday. But I want to address one here. It's a good question. It kind of speaks towards long-term versus shorter-term time frames with trades, market outlooks, etc. This is another capitulation post. Somebody wanting to close all shorts, and that's fine. Look, again, this site, I provide what I see. I give you my thoughts, my opinion. I'll even tell you my positioning on something. But it's just a resource like anything else, just like reading the news headlines or looking at other services or asking other traders what they're doing. So if you're not comfortable, by all means, cover shorts, go long, and hopefully you find some value on the levels that I look at. And I think somebody mentioned here something was this one about using a break maybe of the recent highs as a stop loss. If I'm ever in a position, and let's say in this case a short position, and at some point I realize whether it's I had a firm trading plan that's still in place or not, that it's just not working out, I can't make a case. Sometimes I'll ask myself, can you make a case to short this stock today? If you're in it now, short, and it's going against you or it's not playing out. And if you can't, number one, then what I'd like to do is just then pick you can just close it out right there. But me, I like to just put a stop above the first little bit out of range, just above the first logical resistance level that it's likely to get rejected at. In other words, you might, for example, might be the top of the recent trading range. And on that, let me just kind of segue over, transition into, speak about that. This is, if you're, and I'm seeing the posts right now, and again, they're, what I call kind of capitulation type posts. Remember, this is a market that's gone nowhere. So if you're a short seller and you've been positioned, swing trend short positioning this market for months now, you haven't made money, but you really haven't lost money either. When I say that, it's relatively speaking. What are you doing? If you're just looking for, as I mentioned Thursday before last, a move down to the bottom of the trading range, that's a 3.5 or whatever % drop. That's a quick short-term trade. But if you're positioning for trend reversal and double-digit gains, then you're going to give yourself at least 3-4+% stop, again, relative to your target. 200-day moving averages I've shared recently is, I think, the next likely and logical swing target to the downside, and that would take us down. And I also have a board for you on that one. There it is, T4 area, and that's still, like I said, that's going to be about a 11, maybe 12% drop. And in that case, you could give yourself on a 12% target, you could give yourself a 4% stop loss, and that's still a very favorable 3-to-1 RR ratio. You're risking $1 to make $3 on a targeting 12% profit with a 4% stop loss, or you can even do a 2-to-1, do a 6% stop loss. But either way, the range, as I've shared recently, top to bottom, this box here, where did I give it to you on a 5-minute chart? Yeah, it was, I had it, you know what, I had it measured on the futures. I don't have that chart queued up, but I already told you, I think it's 3.4%. So again, I'm just trying to say, keep that in mind, bigger picture stuff that and again, I'm talking here on the NASDAQ 100. It's my primary index. That and the small caps I like to trade has gone pretty much or almost exactly nowhere now for a few months. So, bulls can't really, if you're positioned only in this index, aren't high-fiving themselves, and bears aren't high-fiving themselves. So it just takes patience. I always make a lot of things up in trading. One of my phrases, I call it a yogiism, is if patience is a virtue in life, it is an absolute necessity in trading. So that's that. All right, and nothing's changed on my outlook. We have the same divergences, are bigger and bigger and bigger. I watch a lot of economic indicators. I don't talk about very often. I do once in a while include them in videos. I look at personal income, debt, personal household debt. I look at leading economic indicators. I've covered quite a bit of those recently, and they're all telling me the same thing. There's this massive disparity, and then the underpinnings that the bulls are citing, one of the biggest being the employment situation. And if you really dig deep or Google and read about this or listen to folks that talk about it, there is the potential for tremendous flaws in that, with the US BLSs or NBRs. I think it is that does the employment, the birth death model that they use. They're basically just kind of making a kind of a wild guess as to what the job markets are, and then the actual forecast. And if you want to see one thing, and I've pointed this out before, and I don't want to go on a tangent too much here, but the best indicators, and I've showed this where I plotted ADP and PAYX. That's ADP, is most of you know. If you work for a company, you probably have your paycheck processed by one of those two, paychecks or ADP. You get your 1099s at the end of the year and all that good stuff, W-2, I mean, and that's ADP. And that's just a tremendous proxy when you just overlay it to the S&P 500. And so here are the S&P 500 punching a new highs, and yet ADP peaked back in 2022, and it's still well above those highs, and it's not going down much, but more importantly, it's not going up. And then again, I've showed before, you have stark divergence, and divergence that is hardly ever seen. You have almost a perfect correlation. Go to a weekly time frame. Again, I don't want to get too off track here. I didn't plan to cover this. Go back as long as you want through the inception of ADP, and you will see it mirrors the S&P 500. When the S&P 500 peaks, it goes down, but there are a few times you get predictive value where when ADP is going down, and again, their business model is simple. More payrolls, they're making more money. Job cuts start, they're obviously losing accounts. And so what's kept them buoyed, and again, there is that stark performance, but that when you dig down in the numbers too, I don't know the exact stats, whether it's unprecedented, but I do know there's a very, very unusual and clear trend right now between part-time employment. The only thing holding up is part-time employment. And that, by the way, that counts. If you go out and you're having a hard time because you get cut full-time, you lose benefits, and you got to make ends meet, and you get 2, maybe even 3 jobs, that shows up on the jobs roll as 3 jobs now being created, or whereas you lost 1 full-time job. But obviously full-time jobs are much more significant, and we've seen a steady drop in full-time employment and an increase in part-time, which is also, again, signs of economic cracks. And where I'm going with that is, if it weren't for that, you'd probably see ADP down a lot more. So again, check that out. Now let me get to what I wanted to cover. I'm going to get to the markets, but I started out talking about the questions on the site. Commodities, love that. Okay, I'll definitely keep the analysis on commodities coming. I think that's, if nothing else, like I said, it's a way to diversify. It's something else. It has a better RR, risk-reward profile, in my opinion. And so here's a question, Randy, in the long-term trade ideas. You have the first listing of Apple. How do we know that's a long or short position? Obviously, it was a short, but it doesn't say anything. It's a good question. First of all, I do my best. I'm a one-man shop. I do my best to keep these trade ideas, the categories updated every now and then. And it could be months that I go in and then update, purge out the closed out ones. But if you click here or hover here, you see trade ideas and your categories. Swing trades, these are setups, active trades. There's a difference there. Sometimes they're both, if a trade's in play and it still offers both oops, where did I go here? Trying to go here. Trade ideas. So you go right here, long-term trades, and if you go to long-term trades, active, I guess that's what Mike clicked on, and you can see here Apple's the first one. You can sort them by date or by symbol. Their default is, I believe, this is by symbol here. So all right, so we're going to click on it, and now when you click on this, there's 2 things that kind of run the query here, or the search or whatever it load. I'm under a category, and this is how the site works. So this was categorized as a long-term trade. 99.9% of long-term trade ideas since I started the site have been long trade ideas only. Typically, you want to hold something that's, and I just find a long-term trade idea. You can see it down here, the definition or the description. Things that you're going to position for months, possibly even years. Not a typical swing trade, which is measured in days, weeks, or months, with a typical holding period of a few weeks. Usually, again, that varies on each swing trade, but long-term trades are different. So now if you click on Apple, it's going to associate both the symbol tag, that's what these are, they're called ticker tags, you can see they highlight, as well as a category because we came in through that way. So now it's not going to load every post I've ever made on Apple down below. It's going to only pull up all posts or any post associated with both Apple. It's in that long-term trade idea category. So, and then you can click that post and you can see this goes back. The post is dated on, let's see, the date's down below, August 3rd of 2023. So this was last fall. And you can see I gave a couple here. And this was Apple. I guess that's the one I was speaking to mainly, is a long-term trade idea. The others were short-term charts on the queue. So this is a long-term weekly chart of Apple. It includes tonight after-hour session trades, and it shows drops to the following divergent highs. Well, and you can read that. Basically, I give you two charts, and this is, again, a weekly chart, zoomed in so you can see it kind of better. Remember, that was August, so what you see, I think you can see in the video. I'm going to roll it up and make it a little bigger. You see a minor, what I call, again, minor on the weekly is a primary uptrend line that lasted months or weeks or months on the daily chart. And so I said that would give you, barring a reversal tomorrow into Friday's close. So this would have been, I guess I made this post on a Thursday. You're going to get a print, a weekly candle. Remember, on a weekly time frame, all that matters is how the candlestick closes at the end of the week. Because an intra-week, you can be down on Thursday or Tuesday below a trend line or a support level, only to see it reverse and park back up. So if trading this time frame as a long-term trade, then what matters is the weekly. So highlighted what will most likely be a breakdown and a confirmed sell signal. Take us down here to my next longer-term target, calling for about a 60% drop in Apple. And then, this is the one I zoomed in a little tighter. So there, that was a zoomed out version. There's that candle. And that's what I was saying, whatever you're on Thursday, that candle is not going to reverse. It would take a heck of a rally to get Apple back above there in a single day. And so you got it. And so I had us going down here to the first support. You can see the arrow break. You zoom in a little shorter, 176.15. Then another reaction at this long-term trend line, but then my bigger target was down here. We'd ultimately take out that trend line. So let's just revisit Apple now. And again, very few. I don't update these often because people right now are giving up because the market's been trading sideways for a couple months, a month or two, and very few, from my experience, ever have the patience to position and hold for these long-term trades and ride out the counter trend bounces. But all right, let's see where that was. Let me get rid of this histogram here for a second. That was a weekly chart. I used a different board. It was this board right here, and you can see what happened then. This was that sell signal. Was that it? Yep. One sec. Let me make sure I have the right board. Yep, I sure do. That was it. That's early August right there. So that week, what happened is it continued to build. So whereas I said the sell signal was almost a guarantee from Thursday heading in, with one more day to go, it was a unmistakable sell signal because you closed the week, a solid close down there. And then went on, made a equal basic marginal new, or that's what I talk about, marginal new high, still very much a divergent high. But first of all, hold on. First thing that we did is we hit my first target. Remember, 176.15. We bounced. Remember, I've had, if you go back and look at the trade ideas, since the beginning of 2023, we came in long the year in 2023, and Apple was my single top pick. Apple and Amazon, those two, my favorites, overweighted. It's been a long, and then several long trade ideas, including in the beginning of the year, we had one more bounce and we caught a bounce. So that's been posted as, other than this very long-term trade idea, we've had swing trade ideas, more longs and shorts on Apple. And, weren't a lot, probably 3, 4, 5 since the beginning of 2023, including into this year, catching the little bounces. But this is active trading. That's why you have those arrows. Even a long-term trader can do this, because if you sidestepped it, let's say you covered at 176.15 and you gained that bounce that I expected with the arrow break, Well, you turned around, you made 8% on the bounce, just saying you captured it all, or at the very least, you averted an 8% give back on your profits, which would have took you back almost to where you were. And then we went on, and you can see where was the next reaction? Exactly on that trend line there, and it was an even bigger reaction. And that's also when I was highlighting hands down bullish on Apple back. Remember all those yellow lines, the purple lines, the key support levels back in last fall? Said cover all shorts, we're going long here, we're going to bounce. We're 200-day moving averages on most things are holding in the markets, and they're all at those key support levels with positive divergence on the daily. So that was another long entry on Apple. But it's kind of showing you the bigger picture, and the bigger picture is playing out the way this one should. Initial leg down, reaction off an even better support level. This was just a kind of a minor, relatively minor trend line horizontal price support when we bounced. This was a much, let me say it again, much more significant trend line, an extremely significant one. It's one I've been highlighting for a long time. It comes off the 2003 lows. This is what I call the secular bull market uptrend line from Apple, which has now been broken. Most importantly, when I go back that far, I give the highest weighting to a monthly chart. I've covered this quite a bit. There's that same trend line here off the 03 lows. And last month, we had a confirming sell signal. Does it guarantee with 100% certainty Apple's going down to my longer term targets? No. Does it significantly increase the odds that it will? Yes. Meaning the odds, in my opinion, are comfortably north of 50% that this is it for Apple. That Apple, over the next year plus, is going to go down more than anybody out there, probably, certainly almost anybody listening to my voice, but even anybody you'll listen to can believe Apple will be down here where I believe it's going. Next stop on this monthly, about 134, 135 down here. And then ultimately, this is a potential long-term target. It'll wipe out about 2/3 of the value of Apple. And again, I know most say that's possible. There was a 62% drop during a bull market right there. Or actually, no, that was the last real bear market, 2007 to 09. And Apple got cut down in about a third, 62% drop, dropped 83% back here. All right, and again, this is going to be plenty of rallies along the way, even if I'm right. And the other thing, if I'm not right, guess what? This is one of dozens, if not, well, of course, hundreds or thousands of stocks out there. It's going to be one of dozens, if not hundreds, of trade ideas I'm going to throw out over the next year or so. And so you don't put all your eggs in that one basket. And let's see, what else did I want to cover on that? That's basically it. I just toggled back to that weekly chart, but I just wanted to show you that trend line has also been taken out not only on a weekly, but a monthly basis. And right now you have that previous reaction low, which let's not forget, it goes back to my daily chart, again, which I've been covering. These are the purple lines. These lines were created back last summer. And this is where Apple defended, and we went long and bullish Apple and the market at that point. We also caught it long and bullish back here coming into the year right there. Caught that. We had a long trade idea there, and we were long and bullish there right there on Apple. So track record on Apple, batting maybe not 1,000, but close to it. Now, given there were, been looking for a major top in the market and everything for a while, but that doesn't change active trading and swing trading. And again, you can just go back on the site and find all those posts and videos at that time. And we did have a short back here on Apple, so there have been shorts, and that's where we're at. But look, here's where we're at, big picture, and then I'll move on and get away from Apple. I just wanted to show you how to use that function there on finding trade ideas. And let me know if there's one that looks stale and outdated, then just let me know, and I'll try to recategorize it. But you can go in and find things that way. And I showed you how to find the charts, because that link to that one post took you to the chart that gave you the long-term outlook for Apple. And coincidentally or not, it's not the first Mag 7 that died. Tesla kind of died first, but this one, just don't underestimate the importance. There's something going on with the markets. If Apple takes out, which by all accounts I think it will, I don't see really a reason to step in and buy now like I did before. We caught some bounces. Right now I can't make a case to go long, even though we're back at the same purple support levels that we were at back last fall when I made it a case to go long Apple. This time around, no, not so much. Why? One reason, we're below the 200-day moving averages. That's huge. Back then, we were testing the 200 days, and the 200 days just do a phenomenal job on Apple of defining. And you go to a weekly chart here, they're the 40-month I'm sorry, 40 period moving averages, but you can see we've taken them out on a weekly basis as well, and Apple's trading below. That's these blue and red lines, the exponential and simple. So anywho, so this is just another FKA, formerly known as Mag 7 stock that's no longer, clearly no longer magnificent. And again, if I thought the outlook was good, me, I like to bottom fish. I like to go long things that are going down that no one else wants to buy, just like I like to short things that are going up that no one else wants to short. But right now, I can't make the case to buy Apple. If anything, if you put a gun to my head and said you got to go long or short for the next 6 months, I'd have to short it. I won't right now. I want to see some of the other sell signals I've been looking for trigger on the indexes and the markets. But let's move on. All right, so let's talk about the markets while we're on Apple related. QQQ, let's go to that 15-minute chart we've been focused on. And this is just that big box, that sideways trading range. Like I said, last trade idea, swing trade idea, and active trade, but was a short here on Thursday post-Fed, expecting a move back down too, and then ultimately most likely below the bottom of the range. We're zigzagging lower. We had a little pop, technically induced today. If you see, there's the downtrend line off the highs. And I want to speak to this real quick. So, saw this happen today. And that was post-opening. The Pavlov's dogs, i.e. the dip buyers, came in and bought. But look, they faded that and then some. So right now, what you have, technically speaking, is a false breakout. Let me go to a 5-minute chart. You can see it here on a 5-minute chart. This is the downtrend line. Okay. Why, as an active trader too, you know me, I'm an active trader as well. I told him in active trading mode still until we get solid breaks down below here. But why didn't I take that breakout? I'll tell you why. It looked, it would look good, look like the real deal, well-defined trend line. The buyers came in, but look how hard the reversal is. Well, here's why. You know me and my silly little color-coded zones. TNX, 10-year Treasury bond, 60-minute chart. Where are we at? Nope, no. IEF, that's the yield. IEF, this morning, way back down into the yellow zone. Look at that. Took out, we had that brief pop above, and as I told you last week, I said I put my money on it's going to fail because it has divergence. We're just barely above there. Hard rejection back into the zone. Now, in one day, look at it. We ended the week last Thursday back there, right? PC numbers came out on Friday. For those of you that track the news, markets were closed, but the Fed's preferred inflation gauge, PCE, came in kind of where expected, and no news. And there was no immediate reaction in the future. In fact, futures were up this morning. Remember, they were closed Friday along with the markets on Good Friday. But look at that. Boom. Big rejection back into the zone. In fact, we gapped here. So this is why, and I've explained this for weeks and months now, the yellow zone is an area where I consider short, where it kind of puts you back into short rallies into resistance mode. Or you can continue again if you're, depends where you're at, but if you care to short, that's where you can short stocks, especially rallies into resistance, objective entries, or you may want to pass on breakouts that happen like what happened today. Green zone is where, hey, unless that green zone's happening for a flight to safety, which I did address last week, things I saw kind of indicated to me that was likely a flight to safety bid. But either way, you can see now bonds falling sharply today, yields going up all the way in one fell swoop. We entered back, and that's the other thing, guys. Just like QQQ, what I just showed you, you've heard me say this a million times. Nothing in trading that I know of is more bearish than a false breakout. Because when a breakout happens, so what happens, again, let's just assume others see what I see, and IEF traders, oh, you know what, it broke out. Randy thinks it fails, but that's a breakout, so I'm a mechanical trader. Breakout's a breakout, I'm going to buy it. And so a bunch of people jump in and buy the 10-year Treasury bond, right? And the shorts capitulate, they cover, they get out of their short because that resistance level's been taken out, and they see the trend line break as well and all that. Okay, so then what happens when the breakout fails, all the longs that bought say, oh shit, I'm wrong. And their stops are either mechanically hit or mentally hit. They say, oh, man, that breakout's clearly failed. And then the short sellers that got squeezed out say, you know what, I want back in. I've been bearish treasuries. So that's why I always, from my experience, or at least my theory on why failed breakouts tend to be very bearish. And the same thing happens in reverse, on a downside break, short sellers pile in. Then if the breakout fails, they have to cover, and then the longs pile in. Okay, so enough on that. It is what it is, and again, that would have been and was, in my opinion, a reason to be at least skeptical and maybe just hold off on the little minor trendline break on QQQ. And now, more importantly, we're back down towards the bottom of that range, and in the fashion that it's happened. I even told you before, I thought if we get down to the bottom, just like on the range on QQQ, my guess is, of course, maybe it's still support. We could have another reaction first, probably will. But ultimately, I think it goes whether we have a reaction or not. Then we get into my orange zone, which, as I've been talking about, that's where the stock market really starts. It started to take note of rising yields. What I mean by that? Well, as I just said, despite the fact it wouldn't go down for the last month or two, the market wasn't going up either, especially the important stocks, the big ones, the tech stocks. And anyway, this is where, if and when we get in there, and it's not an all or none thing, it could prove to be, because that's a pretty well-defined support level now, but it's more incremental. The further you get down, this just means yields are going up. And you've already seen what I've been predicting for months now, that all of a sudden the narrative starts to shift. What if inflation's, remember Powell had that mission accomplished speech? That's what a lot of folks call it, even though he didn't use the words. Was it back in the, December meeting? October? Whatever, it was last fall. And so this would be no bueno for the stock market. This would be, like I said, this is where the market just, if we get there, short anything with a ticker, in my opinion. All right, but again, let's see. Let's not get ahead of ourselves. We're back down to support, and support is support until and unless broken. The other thing, remember I gave you a zone recently on crude oil, some zones, I should say. And this is, I've been saying for months, and now I'm seeing others starting to talk about it. Crude's in an uptrend. Crude took out a downtrend line. Crude took out price support. Crude's been clearly making higher highs and higher lows, and now crude's entered my orange zone. So that puts, these zones don't necessarily match, because crude oil has absolutely nothing to do with U.S. Treasury bonds, but these are, in my opinion, two of the most important things to watch, and now I'm going to give you the third. And that's going to be financials, particularly the banks, but really all financials. So, okay, now, I've had a lot of things I'm watching. Like I said, I focused on the sectors of the S&P 500. I went through those quite a bit, gave you my key yellow support levels, and said, look, when the majority, particularly the top four sectors, that is in order of weighting, technology, healthcare, financials, and consumer discretionary, XLY. When the majority of those go, those will be check marks, increasing the odds we're going to go down. My yellow level on XLF, the financials, is 40.53. Tech being the biggest and most important sector, looks just like QQQ. It's been in the trading range, and just like QQQ, I have a line at the bottom. That is my key level, and it's about 204 on XLK. But XLK already broke, put in a bearish engulfing candle and a divergent high back here. It's never moved above the top of that bearish engulfing candle yet. It's not going down, but just like the market, it's going sideways. And just like the market, needs to take out that 204 to sharply increase the odds that we're going to get that correction taking us down to that, whatever fourth target or whatever I gave, the swing target, the 200-day moving averages right here. And that would take XLK down, roughly in line with QQQ. Okay, and remember, XLK is, over 25 or a quarter percent, 25%, a quarter of the S&P 500, and over half of the Nasdaq 100. So that's why that's so important. But here's one that this is the financial sector. And this is XLF. The top components are your big mega financials, Visa, MasterCard, the big banks, JP Morgan, Bank of America, Citi, and you've got insurers in there and everything. You can get a more concentrated look going to BKX, was it? BKX. And there's the bank sector. So here's the KWB bank sector. And this has, big banks, financials in there. Or you can just watch the big banks directly. Okay, so a couple things happen. We know definitively we would have seen another leg down in the bear market, much lower lows. I'm talking below the October of 2022 lows in the bear market. we'd be in a pretty bad recession. So the financial system could have actually imploded if the Fed didn't directly bail out the regional banks when we had the three big banks, two of the largest in history, collapse back, with Silicon Valley and the other two. And so the Fed backstopped the banking sector. And so there's this, even back in the financial crisis, they also backstopped even the big banks back then. This time it was the regionals, but the regionals have tremendous importance, especially in the commercial lending sector, and it would have ripple effects throughout the financial system. And so the Fed saved the day, and that's where we are today. Now, with that being said, they've created, and they've been doing this for years, continue to create a tremendous amount of moral hazard, and in my opinion, gross distortion. I've talked about the fact that credit spreads, which are the difference between what high quality U.S. Treasury bonds are paying and what below investment grade corporate bonds are paying. And credit spreads right now are near historic lows. In other words, they're pricing an absolute zero risk. Everything's fine. Nothing can go wrong with the market. And that's always a possibility. Sometimes the market just shrugs off bad news, events, wars, geopolitical events, major failures of institutions. Okay, where I'm going with y'all know that. The thing is, watch these big banks, and I'm going to show you why here in a second. So there's Bank American. The charts are almost identical. Divergence, Wells Fargo. I don't have that trend line drawn up, but you can see the big divergent high. This is on the daily chart. So it looks to me, even XLF, of course, it put in recently back here, bearish engulfing candle. I had the primary trend line in yellow, and this is my benefit of the doubt trend line. It's just above. So watch these trend lines. I still have and have not changed these yellow levels. This is kind of the all-in moment for shorting the financials and the market when 40-50 goes on XLF. That to me is an important level there. It will have wiped out all this, break out above that consolidation level and all that. But why is it so important? Let me take a look at some. Okay, so the markets, smart money, institutions, those have been doing this a long time, will watch credit spreads closely, which I've told you. I don't even need to pull the charts of credit spreads because I can just watch what Treasury, I always know because I've been hyper-focused on Treasuries lately, and then what junk bonds are doing. So you can just look at JNK, which is a junk bond ETF. We're looking at their holdings here, or the other one, which is LQD, right? No, not LQD. HYG. So LQD now, those are your investment grade corporate bonds. And I've talked about this quite a bit. In recent years, we've seen just this huge issuance on investment grade corporate bonds to the lowest tier. Anything, AAA is your best rating on a bond. Then you go down, there's plus and minuses in there too. You can be AAA minus, and you get AA, single A, triple B. Anything below a triple B rating, that's double B, single B, or C. Those are considered junk bonds or investment grades, and they're still paying their interest on the bonds, but they are at a much higher rate, and they're very rate sensitive. So the junk bonds will trade in line with the stock market more so than interest rates as all other bonds. However, I've talked about this. There's been a massive issuance on the lowest end of investment grade of these investment grade corporate bond ETFs, LQD being the biggest one. And so what I did today, I pulled the holdings just to kind of see. And I do have I've had watch lists before where I track them, but you can see there's thousands of holdings in there. At least altogether. Let me just show you number of holdings in there. I'm getting off track here. I saw it today earlier. It's got thousands of bonds in there, thousands of issuers, but a lot of them just hold a very small percent. That makes up a very small percent of the overall portfolio. But here you can see the top issuers are Bank America at 2.74, JP Morgan Chase at 2.71, Wells Fargo, Morgan Stanley, Citigroup, Verizon, Goldman Sachs, Oracle, AT&T, and then T-Mobile. And then it goes down from there. You can look at the detail holdings, and you can see right there, and it also tells you banking it's a quarter of the of this right now. And so that's where a lot of money's gone in. You've got the backstop from the Fed. Well, whether it's real or implied, at some point, just imagine if the Fed decides to stop backstopping the Fed. Maybe they can't do it anymore. Maybe they're trying to shrink their balance sheet, or have been trying to shrink that. So all I'm saying is if and when we get the breakdown's the best way to go. You want to really know what's going on in the banking industry, unless JP Morgan's JP Morgan. Jamie Dimon is your very, very close cousin who talks to you all the time and will tell you anything. The best way for you and I to figure out what's going on is watch the charts. So I have these trend lines. They're still above the trend lines. And, the credit card companies, Visa already broke down. There's MasterCard breaking down recently. And so if and when these follow, what you're going to then see is it's going to increase a risk premium. When the stocks start breaking, it's going to be for some reason or another. And then at some point, my theory here, and it's not a guaranteed this must happen, but it is something to watch for again. So you start to see the banks break down. They're going to be downgraded or subject to downgrade or put on watch. And then some of that lower tier stuff below them, JP Morgan's obviously not, barely, just above junk rating, but it's usually a cascading effect. And therefore, my theory is that I know how these bond ETFs work. If you have LQD as an investment grade bond ETF, if you read through the prospectus, it must hold investment grade bonds. So what happens if there is a credit event or something happens a quick shift in the financial markets, and you get this cascade of rating downgrades? Well, LQD must, by perspective, start selling off those bonds that were formerly investment grade and now got downgraded a notch or two and are technically junk bonds. JNK can buy them, but there's a lot more money in investment grade bonds, and so you see that's one of the things I'm watching for, guys. And I know I've been warning all these potential risks that can happen. And again, I'm not just making a prediction it's going to happen. I'm telling you, I'm trying to share when the timing, so you can then act on it, whether that is to get, increase short exposure, to get short on the markets, or to maybe take some money out of your S&P 500 index fund and your 401ks and all that. Just watch the banks. That's what I'm saying here. Watch the banks. If the banks get downgraded, now you can watch the other sectors. Go back to that, pull it yourself. Go to LQD, go to iShares.com, LQD, go to holdings, and you can see what they hold and what they're heavy in, and you can look at what I said before, the ratings, which I've shared. Let's see, go back to that. Somewhere I have the credit rating. Oh yeah, here it is down here. Credit quality. So you check this out. There's so you can see almost half of the bonds are sitting there at that barely investment grade rating. And the other almost half is just a notch above that. So your AAA bonds are almost non-existent, 1% holdings. So anywho, that's something to watch for. Again, something I touch on in the past. Let me cover a few more things so it's not a super long video. Let me grab my notes here. Just kind of, again, one more time, looping back to the markets and speaking to those that, might be, and again, whether you're throwing in the towel, whether you're wanting to go long, looking where to get long, whether you're short, looking where to cover. As I said, we're still in this trading range right here. And you can see right now, I'm going to draw a little line right here, just about the recent lows. There's this sub range right there. And I often notice that in a trading range, you can usually draw a line on or near the midpoint that delineates the trading range. And so from my experience, so there's a period you were trading below it, you made a breakout candle, and once you break above the midpoint line, wherever you draw it, again, it's not always exactly in the midpoint, quite often it is, or just a little above or below, then you tend to go, once you change sides on the midpoint, you tend to then go to the top or the bottom of the range if you were breaking down from below. So if you break these recent lows, again, you can see pretty clearly there. Here, I'll put the line and tell you where it is. It's right about here, right about 433, give or take. Then that, especially a daily close below, will most likely take us down to the bottom of the range. And you can see from LQD, or was it LQD today that I showed you? IEF, Treasury bonds, how it can happen in very quick order. In one fell swoop today, we entered back into the my yellow zone, and we went immediately down to the bottom of it where I started the video. So that's what to watch for on the stock market. Apple, I already gave you my thoughts on Apple, where it's going. Something's wrong there. Again, and Apple isn't Tesla. Tesla was a crowd favorite, kind of new thing and overvalued, but Apple holds tremendous both psychological importance to the market as well as mathematical weighting. It's still a very, very heavy. It's no longer the biggest one, but it's up there. And the others are just right on the verge. I won't go now. Microsoft, everything's sitting right on support or close to it. Most of them close to it. Let me make sure I cover everything else I wanted to cover for you. That's it. I don't want to go off on too many tangents, but I already covered USO, showing you that it continues to rally, and that is, and I'm hearing what I predicted months ago that you watch, crude keeps going up. I can't guarantee it will, but it's in an uptrend, and here's the levels. You're going to hear more and more about this. It's going to put the brakes on Powell, what he can do, because you're going to hear about the reemergence of inflation. So that's going, and then nat gas, UNG, threw that out on Friday as a trade idea, and there it is. We took out, there's divergent low, popped R1, so we're above there. It's up 5.5% today. The fact it's taken out R1, first resistance. Remember, you had two buy signals you could have done. You could have took it, I told you, took it Thursday. It was just an anticipation because the chart looked so good, and starter, and then added. You see it there is a breakout, and now we took out R1. We gapped above it, and that's again another reason why natural gas futures are going to get you in earlier if you're an active trader. See, with natural gas futures, you can see the breakouts occur in real time. You're not subject to a gap like is so common with UNG. And then boom, took out the secondary trend line, and then boom, boom, boom. These are the targets I gave you, I think, on Thursday. Let's stop there. I will. As I said, there's a bunch of sectors and things that I want to cover, but I already mentioned those to you, the ones that are on my radar, such as the restaurant stocks, the leisure stocks, now the financials as well. And, I share them as both trade ideas if you're looking to go long or short individual sectors. Unfortunately, I'm just not seeing a lot, other than commodities, I'm not seeing a lot that I like on the long side, and I don't force trades. I try to, if I come across something I think looks good, I'll share it with you. And we have had overall imbalance. I think if you look at the trade ideas from more longs and shorts this year, we've had offhand, I can think of at least 3 or 4 that were 20% gainers this year. IEP, natural gas, there's gold and silver. We were in on that right before this recent run, the miners. But at this point, like I said, nothing much has changed in the technicals. We're still in that trading range. The same case that was, could be made a few weeks back is still very much in play now. If anything, more so because as we go sideways, you're getting these longer term, the daily momentum indicators starting to roll over. You're looking at some more PPO crossovers and things like that can trigger, sell signals or other traders to sell. Watch the 20-day moving averages on the indexes and things like that, and then and most importantly, the price levels I gave you on the yellow lines and all that. All right, I'm going to end it here and then try to dig up and see if I can get some more and maybe some new trade ideas out to you. And I'm really working hard. I'll try to find some long setups, even in the equity markets, for those of you that are, because I hear quite a few of you are cheering the rally that we had. And I listen to Wall Street. I see the headlines. We're up 10% in the first quarter. So, statistically speaking, in this election year, that means the market's going to be up. I don't trade off those things, because the problem is, most of the time, 90% of the time, the stock market does go up. But when the technicals are saying otherwise, especially in those periods where everyone thinks one thing, and they do right now, the sentiment surveys tell us that, positioning and everything else, and something else happens, that's when the biggest moves come from. So there's nothing wrong with being long right now in the equity markets. Just don't be married to or fall in love with that. And if you take any value from the site, the same levels I'm looking at to increase or add to short positions are levels if taken out you might consider stop loss orders, or maybe holding off on buying the dips, if the dips exceed those pullbacks to those support levels I mentioned. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.